let's talk about this 50-year mortgage plan, man. So Trump announced, I want to say 2 days ago, 50-year mortgage plan that's in the works. It's not live yet. You can't go out and get a 50-year mortgage plan just yet. But how are you feeling about that?
Well, just to be honest, my initial knee-jerk reaction is that it's not a good idea. That I'll just go out and say it, just so it's out there. But I think from what I heard and from what I understand, with the rising costs of home prices these days, there's a growing pressure for home affordability to become something that is more of a reality for people. I think that with home prices increasing as fast as they have, the possibility of home ownership seems like it's more out of grasp for regular people. And I think that's sort of the driver for this. So I think that the idea with this is if we have a 50-year mortgage, it would reduce the monthly payment to a point where people can afford the home prices as they are right now. I think that was the general idea. And that was sort of an attempt at a solution for that problem. So, from what I understand, that was the general pitch.
Yeah.
I think it's important for us to kind of look and see, does it actually make home ownership more affordable or not? What we'll do is we'll see kind of what actually plays out, so we can decide for ourselves, does it really help or not?
Yeah, I think he announced this. I'm not sure, where he came up with the idea from, but I think he announced this in order to try and help stimulate the real estate market. Obviously we all know it's a buyer's market right now. But there's some major issues that I have with this particular plan. Before this, I have heard of 40-year mortgages. I actually did a subject to deal on a house that had a 40-year mortgage. I want to say 7 years ago or so. So 40-year mortgages have been around for a while, and those are no good as well.
I've seen those more as a loan mod, or either second mortgage or like a loan mod option, if someone was paying down their mortgage and they had trouble making the payment, they would do this loan modification in the middle, where they take that and spread it over 40 years to make the payment more affordable for the person. But I agree, the whole concept of spreading out a mortgage for more time, for a longer term, although it makes it more affordable and makes the person comfortable at that moment in time, and they get to keep their house, the amount of interest that they give the bank multiplies like crazy. And so it's one of these things like that. That's some of the numbers we're going to look into tonight, because what it does is it puts a Band-Aid on a short-term problem and the cost that you pay is astronomical in terms of if you're trying to fix a cash flow problem, or if you're in a tight spot, if you get one of these longer term mortgages, the amount of interest that you give the bank is absolutely ridiculous, and they are super happy to take all your money. Happy. So
at the end of the day, it's going to be like renting from the bank for 50 years, man.
For we're talking half a century.
Like you said, somebody who's 20 years old who buys a house is going to have a mortgage until he's 70.
Until you're 70, and that's if you never get out of the mortgage. But
that's not even strategically using equity to build a real estate portfolio. Really, if you think about a 50-year mortgage plan, it's going to take you probably a little over 20 years, if we look at the real numbers, 20 years to start making a dent in the equity that you're building in the house. It doesn't make sense financially.
So let's look at some numbers.
Let's look at the numbers, man.
So I wrote a few things down. So if we're strictly talking interest and principal, so the first month's payment for a 50-year mortgage, and we're talking about a $300,000 mortgage at 6% for 50 years. The first month's payment is $1,579.21.
This is at what price point again?
A $300,000 mortgage.
$300,000 mortgage.
So, $350,000 house has a $300,000 mortgage
on average, right?
So The payment is $1,579.21. Out of that,
that's at today's interest rate, right?
That's around 6%. Yeah, so give or take, so around 6%. So $1,500, 95% of that payment goes to the bank on that first month that you make the payment, and $79.21 goes to the principal. That's what pays down the house. We've talked before about the amortization schedule in general and how it's not necessarily built for the consumer's best interest. It's really built for the bank's best interest. So this just exaggerates that like crazy, right? And so the whole issue is that you have this fixed payment, and the interest portion is based on the balance. So at the beginning of the loan, you got this fixed payment. Because the balance is so high, the majority of that payment is interest, and whatever's left over, you get. Well, with this 50-year mortgage, $1,500 of your $1,579 goes to the bank, and you get the $79 is left over. After 12 months, after 1 year, you will have given the bank $17,009 in interest, and you would have paid the house down by $977. Not even $1,000 of your home would be paid down after 1 year. 10 years, you give the bank $176. This is a $300,000 house. After 10 years, you would have given the bank $176,000 in interest, and you would have paid the house down by $12,009. You wouldn't even have paid down the house by 10% at that point. After 20 years, you would have given the bank $342. After 20 years, you've bought the bank another house, $342,000, and you'd have paid down your equity by $36,600. So the point at which, so if we've talked about the amortization schedule, there's a point at which the amortization schedule, you're at the beginning of it, you're giving the bank the majority of the payment, and then you get the least. There's a point where that switches, right? With a 30-year fixed rate mortgage, it's probably 14, 15 years.
I think we said it was 17 years.
Oh, yeah. Okay. 17. Right. Yeah. So with a 50-year mortgage, it takes 400. So in this scenario, $300,000 home, $300,000 mortgage, 6%, it takes 462 months. That's 38 years and 6 months where you're giving the bank more of the payment than what's going to principal. 38 years and 6 months. That's how long it takes for it to switch. Like, this is not like it's not even that much more affordable either. That's the thing. It's like, so a 30-year fixed rate mortgage, $300,000 mortgage for 30 years at 6%, your payment is $1,798, $1,798. That's principal and interest. And the principal and interest portion for the 50-year is $1,579, which is a $219 difference. Now I feel like, I'm sorry, guys, I just went on a numbers rant, and I just realized I did that. Please forgive me, but this is glaringly against any consumer's best interest. Of course. And it's glaringly in the bank's best interest for a difference of $200 a month.
So now think about this. And then on top of that, the average home buyer right now. So it used to be at one point that the average home buyer, average first-time home buyer was 33 years old. Now it's the average first-time home buyer is 40 years old. So imagine somebody at 40 years old, 40 years old now.
I did not know that.
Yeah. Imagine you buying a house, and I buy a house right next door right now, 44 years old, 50-year mortgage on it. I won't pay that house off. I'm going to be dead by the time the thing is paid off. 95 years old, man. That's crazy.
It's crazy. It's going to outlast your job. It's going to outlast your retirement. I mean, you may die before you pay off your house. And it's one of these things where it just completely exaggerates that reality for people. And, you know, the prices of homes going up is a challenge, but I don't see this as a solution. So when we qualify people to see what their max purchase price is. We look at their income, and then we also consider the debt, and it's called the debt to income ratio. And so the amount of debt the amount of monthly debt that they have as compared to their income is one of the main factors that calculates to the max purchase price. One of the main things with that debt piece has to do with what's called the projected housing expense. So it's like, when you get this new house, what's the payment going to be? And that's part of the debt that we use to calculate the debt to income. Well, if it were true that a 50-year mortgage would help people afford more expensive houses, then the payment would have to be significantly lower for us to be able to lend more money, if that makes sense. So does that?
Let me stop you right there. To your point with the 50-year mortgage, the only way I really can't see any scenario where this is actually going to work. But let's talk interest rate. Let's say that the interest rate is 1%, which is never going to be, because there's more risk in a 50-year mortgage. I think the interest rate is going to be higher than what it is right now.
Right.
Even over the course of 50 years, I mean, you're never really paying off the house. So even if you try to sell the house at some point, the average person stays in the house for what, 12 years at this point? It used to be 5, now it's 12.
Yep.
Even at 12 years, you don't have enough equity in a house to be able to liquidate. You're going to be stuck.
You're going to be stuck because you haven't paid down the house enough for you to be able to sell it. And like, let's not even like include the fact that if your house happens to decrease in value, when you're paying down the balance of your mortgage, if your home decreases in value, you've paid it down enough to where if you try and sell, you're not upside down. But with a 50-year mortgage, if you don't put a bunch down when you first buy the house, if you're if you're maxed out on your mortgage amount and the home price comes down, you haven't had the ability, and we're talking within 10, 20 years, you haven't paid down the house at all.
At all, man. 38 years. I didn't
38 years
on that. 38 years is crazy.
So, sorry, I've got my mortgage calculator here, so I can run some
Let's do it.
Easy numbers on the fly if we need to. But I
mean, maybe there's going to be a huge tax incentive, and just so everybody knows, this is all speculation at this point, because none of this stuff exists. We don't even know what the interest rate on this is going to be. I can't see any interest rate working. I can't see any 50-year mortgage working. I just can't see how this is going to work. You know what I mean? Even on rental properties, we're talking to a bunch of investors. Even on a rental property, we're talking about a difference of $200 in cash flow for a 30-year mortgage versus a 50-year mortgage.
Right.
It doesn't even make sense.
If it were $1,000 cash flow,
that's different.
It's different, right? If it were $700 in a difference in the liability, even for qualifying people for higher loan amounts, from a qualification standpoint, if the goal here is to make it so more people can qualify for expensive homes, then the payment would have to be significantly lower. But it's not. The payment isn't significantly low. It's a couple $100, which is not going to move the needle enough for someone who can qualify for a $200,000 house to be able to buy a $400,000 house. That isn't enough. It's not going to move it enough to make it these expensive home prices affordable, or it's not going to help people qualify to buy homes that are overpriced. It's so the whole idea that it's a fix for this problem, it doesn't fix the problem. It doesn't fix the problem that home prices are too expensive. But in turn, the outcome that a lot of people, bankers especially, probably don't want to talk about is that it's completely against your benefit. You don't pay down the house at all. I mean, you do. I've always been someone where I've wanted to not say things like you don't pay down the house at all when it's not actually true. It isn't true that you don't pay down the house at all. You do pay down the house a tiny amount to where it's, and you give them a lot. So that same scenario, $300,000 mortgage for 50 years at 6%. You give the bank over $600,000 in interest. You pay for 3 houses. right? That's true. That's what would happen with this. And so
in order to save, just to be clear, in order to save $200 a month,
to save $200 a month,
that's crazy.
It's crazy. And I mean, for anyone who's seen the videos that I've been on with Jamel, I don't get charged up too much about things. I like to take a rational approach. This is so ridiculously bad.
Mm-hmm.
It makes me frustrated, and it makes me angry, to be honest, because there's no way this is in anyone's interest except for the banks. It's impossible. I'm sorry. Yeah.
Now, two things, man. Some people might say, well, I'm renting a house anyway. I've been renting for 50 years. Why not at least buy a house and put a 50-year mortgage on it? Does it even make sense to do that? Do you see any scenario where this is actually a good thing?
So yes, I can. If you were to get this and treat it like, treat it like it's a, like it's 30-year fixed rate mortgage or a 20-year fixed rate mortgage, right? So if you're overpaying toward principal every month for the same amount that you would with a 30-year fixed rate mortgage, it's going to be a 30-year fixed rate. It's going to be a 30-year amortized mortgage.
So basically take the extra $200 that you're going to save and put it back into the mortgage.
Put it back in here. You could do that. You could definitely do that. And that would be a fail safe. And then if you get into a tough time or something like that, you need an additional $200, then you can go back to paying the $1,579 instead of the $1,798. Right?
The problem I have with that, most people are not disciplined enough to do that, man. Most people, right. I'm talking about 95% of people are not disciplined enough to make that extra payment. I don't get it. I mean, people live paycheck to paycheck as it is, which is why this.
I agree. And
is proposed.
And mortgage companies don't exactly make it easy for you to overpay either. And so that you got to jump through a bunch of hoops. You have to write on there, this is toward principal for this month, whatever like they make you do. They don't make it easy for you to do it. Because of that, it de-incentivizes people to do it every month, even if they are disciplined with taking action. Because it's hard, it makes it more difficult for people to be consistent with it. And then all of a sudden you're not doing it, and there's no harm, no foul, because it's not that you need the $200. It's every month. It's just that to do something that's difficult over and over and over, if it's not streamlined, if it's not automatic for you, the likelihood is you're not going to keep up with it. And they know that.
I'm sitting here thinking about one scenario where this actually may be a good thing for somebody to take advantage of.
Yeah.
I can see this 50-year mortgage making home prices go up. So if you do these and there's enough of them in the market, the problem is houses they're unaffordable now, which is why we're in a buyer's market now. We're in a bad situation now. This is just going to cause the market to stimulate all over again. And I can see home prices going back up. And the only way that the person is going to benefit is from the appreciation of the property. I really can't see.
That's it. That's the only way.
With a little pay down, I can't see, someone making a significant impact on a property. It's going to take them, like you said, 38 years, 40 years to even do that. The only way I can see the benefit is
the only thing you have,
man. That's it.
Is appreciation.
And tax benefits. I mean, it's literally like renting a house with tax benefits. I mean, you get the tax write-off.
Renting a house with tax benefits, and you get to take advantage of the appreciation.
That's it. You know what I mean? I really can't see no other scenario where this actually works.
So I agree.
I'm trying to think hard about it, man, but I just can't.
I know it's just the amount of money that you'd give to the lender to be able to rent the house is ridiculous.
3 times the money, man. I mean, we're already at 2.5 times the money with a 30-year, man. Imagine, paying double that amount.
Yeah, I know. So, I mean, and we've talked about the 30-year amortized mortgage too, and how if that's not good, this is really not good.
Yeah.
Right.
So if I'm a banker, I'm happy, that this is even being proposed. And, who knows if this is even going to materialize, because I do see a lot of backlash on it on the internet. I think even the most financially unsavvy people know that this is a bad deal.
I agree. I mean, here's the thing. If we're going to do the half-century loan, why not just do the century? Just do a 100-year mortgage. If we want home prices, I mean, we can go extreme.
Somebody said that in the comments, man. It's going to be next is going to be lifetime loans, man.
Lifetime loans. I mean, hey, we want home prices to be affordable, right? So let's just make it 100 years, because we want to be able to afford the fact that homes are way too expensive here.
Those exist, right?
What's that?
Those exist, 100-year loans, man, in Japan. They exist. I don't know how it works. I never looked into it. But once this 50-year option came up a couple of days ago, obviously the internet starts, the algorithm kicks in. They said in Japan there's 100-year. Matter of fact, let me do a little bit of research on it.
That's crazy.
There's a 100-year mortgage in Japan right now. 100-year mortgage, Japan. Yep. There is a 100-year mortgage offered in Japan as a way to address housing affordability. That is ridiculous, man. That's ridiculous.
And they do it.
And they do it.
The problem is affordability.
That's all it is, man.
And you know what happens is that they feel like they're a homeowner, but the bank owns the home. The bank owns
for sure
the home the bank owns the majority of the home for over 40 years. And so all you have to do is, in that scenario, sell the home. You don't get any equity back. You don't get you get a very, very small amount of cash back, because you haven't paid down the home much at all, to put a tiny down payment on the next house, which doesn't help you afford the next house. It incentivizes you to have to get into another 50-year mortgage starting another 10 years later. And then you're giving the bank 95% of your payments starting on day one.
Willie Todd said, "You're not a homeowner, you're a loan owner." That's exactly what you are, man. A loan owner.
Yeah.
So my ultimate question would be this, man. I mean, if it takes you 40 years, 50 years to even cross over to the point where you're paying more in your principal than your interest, what if we did a zero? Let's work the numbers at 0%. Let's say you buy a $300,000 home at 0% interest and you spread it out over 50 years. The monthly payment has to look handsome, but that's a 50-year. Let's say they give you 10 years of 0% interest, and then after the 10 years, let's say they give you 20 years of 0% interest. The next 30, let's say within the next 30 years, I'm trying to work it to where it actually makes sense. 20 years at 0% interest, the next 30 years after that,
divided by
you do, let's say today's interest rate at 6%.
600. So 300,000 divided by $300,000 divided by 600.
20 years, let's just say.
So it's $500 if it's 0% interest, and it's strictly a principal payment spread evenly over 600 payments. $500. But if we're just doing easy math, that'd be a $500 a month payment. Now, $500 a month times 12 is $6,000 a year, right? Times 10 years is $60,000. So you could pay down a $300,000 house by $60,000 with a $500 a month payment, right? But I don't know of any. I mean, the thing is, like, I know where we're going is, like, could we create a loan scenario that would be beneficial to the consumer over 50 years?
And the banks are just not going to do that. So imagine the bank does something like this. Let's say they do interest only for 10 years. And then the next 10 years, they do, maybe 6%. And then every 5 years after that, they drop the interest so that you can benefit from it at some point. Maybe that'll work. Who knows? But I mean, you're paying interest only. So the bank is going to make most of the money the first 5 years, 10 years anyway.
They are. But even if you get an interest-only payment at at 6% for that 300,000, the interest only payment is $1,500.
$1,500, right? So now,
which, if it's amortized, the payment is $1,570. So I mean, it helps, but it doesn't give you a break either.
It doesn't. But I think the banks want to make money. So let's say the banks wanted to make money. Say, give it 5 years, interest only for the first 5 years.
Yeah.
After that, every 5 years, the interest rate drops from 6% down to whatever, or half a point. So 6, 5.5, 5. So that way, the consumer is actually building some type of equity in the house, but it's still going to take. I mean, maybe that 38 years might drop down to 25 years at that point.
Right. True. Yeah, that could work. And if it, I guess it just depends on that. Does that payment stay stagnant or not? Right? Does it stay consistent? Because if it does, and the interest rate decreases, the interest payment gets out of the payment that you make. The interest payment the interest portion of your monthly payment always gets paid first. So, and you get whatever's left. And so as the interest rate decreases, even if the balance doesn't come down too much, if the interest rate decreases, then that's a smaller portion of your payment that goes toward the bank, which means there's more left over for you to pay down the house. And so that could be an effective way to get it done if the banks would agree to it. The challenge with that is the interest rate and the interest earnings are one of the main ways that banks mitigate for risk. So, but given the amount of interest that's here, given the amount of interest that the bank receives, it might actually allow for the banks to loosen their guidelines, or it may allow for them to offer lower interest rates because there might actually be less risk with a 50-year mortgage, because if they have to, well,
you look at Fannie Mae as well, man. They just loosen their guidelines, no credit score. I mean, that's a whole nother video that we can talk about. Well, how do you feel about that, man? I mean, they're literally trying to set people up to fail and take back these houses, which makes absolutely no sense.
I don't get it. I don't understand that.
No credit score needed to buy a home.
We should do another one on that, because that's
a whole nother topic. I definitely want to talk about that, man. If you guys want to see that, leave a comment in the comment section. I definitely want to talk about that. That was just announced the other day as well. So there's all of these new things coming out. I don't know if a lot of thought was given into some of this stuff. I'm not sure what the objective is behind it, but I can guarantee you it's not going to be beneficial for the consumer.
Whatever it is, it's going to be shrouded by, there are certain people who are having trouble becoming homeowners, and we want everyone to become homeowners. So we're going to make it so everyone can do that. I'm one where if someone becoming a homeowner is going to have a high likelihood of them foreclosing on the house and having to go bankrupt, that's not a good plan. That's not a good reason. If we're gonna open the door and have homeownership, and I'm one that I believe homeownership is important. It's the number one wealth building tool that we have here in the United States. The single family home in the United States is the number one investment in the world, which is, we have foreign investors coming in buying them up. You got Vanguard, you got BlackRock. These are some of the biggest organizations with some of the most money buying the majority of, they're the biggest home buyers in terms of scale in the United States, because the single family home is one of the best investments that you can have, which is an incentive for the population to hop into it, right? To do it. Because as you pay down the house, and that's the thing, as you pay down the house, it's a forced savings account. It's a forced wealth builder. And or if you do it on your own, it's a way to build wealth within the 2x4s of your house. That's good. That's great. It's amazing. But if the outcome of the loan is where you don't pay down the house, that doesn't happen anymore. If the outcome of the loan is one where if the home decreases in price, you go to sell it and you owe $295 but you can only sell the home for $250, you're out $45,000. And if you can't sell it, you do a short sale or you foreclose on the house, which is detrimental. I mean, and so there are people that go through those life events and everyone bounces back one way or the other. But some people, they go through it and they struggle for a really, really, really long time. I wouldn't want to set people up for that. And I feel like the things that they're doing in terms of relaxing these guidelines are setting people up who it just increases the likelihood of failure. And that doesn't make sense to me.
No, man. So imagine locking up your money into a house for 50 years. Just imagine that. I mean, making payments, because you can't take out the money once it's in the house.
Can't take it out.
There is a way for you to do that.
Yeah.
And this option is not for everybody because, again, it takes discipline. That's the key word. Yeah. You got to be financially disciplined with this stuff. And people looking for a 50-year mortgage, probably not financially disciplined. If you don't have a credit score and you get a 50-year mortgage, you're definitely not going to be financially disciplined, right? So they're targeting people who are probably going to fail at some point.
Targeting people.
I don't understand why they're doing that, but it's being done. Yeah. And there are other options out there. So there is one option that Anthony talks about a lot when it comes to being able to make a payment but still have access to your money. So imagine that same $1,500 mortgage payment you have on a house and you make a payment on it. Let's say you make $4,000 a month and you make a payment for that $1,500. You put the entire $4,000 into the house. You still have access to $2,500 that you can pull right back out of the house to pay your bills and live with.
Yep.
Right. What's that called, man? Let's talk about it.
Yeah. So it's called a first lien HELOC, a first position HELOC, first lien HELOC. It's a mortgage product and it functions differently, works differently than an amortized mortgage does. And it's an open-ended loan, which means money can go in and money can come out. And we teach people how to use this type of loan. And so what we do with this is we teach people to deposit all of their money into the first lien HELOC. Some people call it paycheck parking. You take your paycheck, you park it there, you put it there. And the reason why you do that is so you can pay down the balance to the lowest balance possible right now. Because the reason, the thought behind that is that the interest is calculated every day. It's calculated daily. So every single day's interest balance matters. So if today's balance matters, I don't want to have a high balance today. I want to have a high balance. I want to have a low balance today, the lowest possible. I don't want to wait 5 days and then put my money in there to create a low balance 5 days from now. I want to create a low balance now. And I don't want to create kind of a low balance now. I don't want to pay it down by a couple bucks. I want to pay it down as much as I possibly can because that creates the lowest balance today as fast as possible, therefore the lowest interest payment as fast as possible. Mm-hmm. And so you deposit all the income in. Well, then you do have to pay bills, right? You do have to buy food and you got to pay for the interest as well. So because the money can go in and out freely, that's one of the main differences between this and an amortized mortgage. You take out what you need and to pay for those things. So through a monthly cycle, right, you deposit all the money in that pays the balance down as much as you possibly can. You pull from it to pay for your bills and for your expenses. That increases the balance. And everything that you did not take out that month is simply still in there. And that's what pays off the house. So we can do an easy math example. It's going to be a little oversimplified, but let's look at this $300,000 example, right? You owe $300,000 in the house. And if the household, let's say they bring in $10,000 a month, they deposit $10,000 in, that takes the balance from $300,000 and pays it down to $290. And then this household is really disciplined with their finances. They live below their means. They make more than they spend. Their average spend is $7,000. Mm-hmm. So they take $7,000 out. to pay for, what they need for the month. That increases their balance from that 290 up to 297. So the beginnings month's balance was 300,000. At the end of the month, after driving in 10,000, taking 7 out, their balance is 297. So they still have $3,000 left in their HELOC. That was the principal pay down for that month. So if we think about that, if that's their habit, if that's their routine, we'll call it 10 in, 7 out, 10 in, 7 out, month over month over month. If you take a $300,000 balance and divide by $3,000 pay down per month, that is 100 months, which equates to an 8.3-year payoff. So in that scenario, this household with that cash flow would pay down the house in just over 8 years, as compared to a 15-year mortgage, 20-year mortgage, 30 or 50. And so that's funny that you laugh. I mean, it really sounds just really, really just crazy, just really ridiculous. It just does. So I can't believe we're actually even having this conversation right now. I really can't. But we are, and that's okay. So at the same time, let's just say this household ends up paying off their house. Well, it's important to also know and remember that every single dollar that they use to pay down the house, they can also access. So once they pay this first lien HELOC loan mortgage to zero, they're not just sitting without access to the dollar, to the money that's in there. Money's in the 2x4s. They didn't lose access to it. At that point in time, they would have access to $300,000 of their home's equity. Now, Jamel, what would you do with that?
Flip it up, man. Get some more investments.
Right. So I mean, it's not the, I'm not necessarily saying it's the best option, but it's a very good option in terms of having access to capital that you could use to invest with.
And then in addition to that, and this is kind of outside of what we wanted to talk about today, but you also have that infinite banking aspect of it as well. We've spoken about that in the past, where you get the life insurance to cover the HELOC at your death. You know what I mean? So that's a whole nother video. If you guys want to see some of that, look at the infinite banking. Look at the infinite banking playlist that I have on my channel. We do deep dives into that stuff on how it actually works. But I mean, you just use two different scenarios basically. One on a 50-year mortgage at a $300,000 home, and then one $300,000 home where you can pay off in 5 to 7 years. The difference is if you get into the 50-year mortgage, you'll never see that money again. You'll probably die before you can actually sell the house. Because the average person is buying a house at 40 years old right now. On the flip side, if you're 40, imagine paying off your house by 45, 47, if you're disciplined.
I mean, 50.
Even 50.
I mean, like our average right now in terms of the amount of principal that gets paid down per month on average, per the amount of money that people owe, tracks to about just over an 8-year payoff. So eight years, 2 months. Our average customer paying down their balance at a pace that would track to an 8-year and 1 month payoff, right?
And the real benefit in it, I mean, there's plenty of benefits, but I think the highlight that we're trying to bring forth is you can have access to the money in the house without having to wait 30 years, 40 years. You don't have to refinance your home and pay $10,000, $15,000, $20,000 in closing costs. It's there on a debit card for you.
Well, so let me
so how does that actually work, man?
So before that, because I do want to get into that too. Earlier, we talked about the scenario if someone completely pays off their house and then they tap into the equity to invest. And that's how a lot of people first envision this because they learn about this and they say, wow, I can become completely debt free. And I just want to pay off my house. And then once the house is paid off, then I'm allowed to now invest with it. And I get that, right? Their main goal is to become debt free, and then we're going to expand from there. But that isn't how it has to happen. So if we think about that $300,000 balance, if someone paid it down to $200,000, you can still borrow up to $300,000. You're just borrowing $200,000 at that point. Your balance is $200,000, but you can go up to $300,000. At that point in time, you would have access to $100,000 that you could leverage if a deal came your way. So you don't, I think sometimes when I explain things a certain way to try and explain a point or something, people think that I'm saying that's the only way to get it done. It's not. This is so flexible. So any dollar that you put into this, you can take out at any given point. So, for instance, if you paid it down to 250, you can go up to 300. That gives you $50,000 that you have at the most baseline level to act as a cushion. Like I have a first lien HELOC, and there's a certain threshold that I'll never go above because my first lien HELOC acts as my checking account. It acts as what I use to pay my bills. It's where I deposit my money. It acts as an investment tool for me as well that I leverage to invest in different opportunities when they become available. But I'll never take out more than a certain amount because I have a certain amount of available equity that I'll never touch because that's my emergency fund. So if something goes wrong, if Congress decides or that, we're talking too much trash about the 50-year mortgage and that they want to get back at me and they say, we're going to make first lien HELOCs a thing that's not available anymore. I have money to fall back on in order to be able to, to feed my family until, we find a new route. So,
which is interesting too. You mentioned your emergency fund is actually within your HELOC.
It is.
So you didn't even have to save it up. It's already there.
It was already there. Right. So, well, mine was a little bit different because it would have been already there if I would have refinanced out of a different mortgage. But I ended up buying the house using a first lien HELOC, which you can do as well. And so, I had 20% to put down from the sale of the other house that we had. But I only put 10% down because that created a 90% loan to value first lien HELOC that was maxed out. So anytime you use it to purchase a house, you put your down payment down and then the amount that gets funded is a maxed out HELOC. So that's how I started. But then I still had that 10% sitting over here in the bank. And I put that in my HELOC to pay it down to an 80% balance. But I ended up having a 90% first lien HELOC line amount. But if you refinance, for instance, if you're at a 70% loan to value, so again, easy numbers. If it's a $300,000 home, that's how much it's worth, right? And you owe $200,000 on it, right? Our first lien HELOC could come in and it could go to a max line amount, a limit of 270, 90%.
70, yeah, 90%.
So you'd get a limit of 270, but we'd only pay off the mortgage, which would be 200,000. So in that scenario, you'd owe 200,000 on a $270,000 first lien HELOC, which means that $70,000 that you're not using, that would be the emergency fund. That would be your surplus, right? And I know where that threshold is for me, right? You would just need to determine at what point am I not going to touch any more of it. And so I've gotten close, I've paid it down, I've gotten close, paid it down. So it just depends on what opportunities are available at that point in time. And, am I more leveraged or less leveraged at that point in time? But yeah, so that's one of the main advantages that this provides too, is that you have the flexibility to pull from this and invest if you want, you have the ability to store emergency funds that you'd usually keep in a savings account that may get you 3%. But when it's stored here, it works for you a whole lot more because it offsets the interest payment here. So you get to use the money that you'd usually keep in a savings or checking account here to pay down the balance and save on interest costs at a much greater pace or a higher rate. And you get to use everything to pay down the house. So I am biased. It's just important to know that. I live this, and it's all we do here. And so it's important to know that. But all these things are true. Our average pay down per customer is tracking to just over 8 years. And so they're living it. They're living the reality that this works. And it's all based in math. It's really an easy math problem too. It's one subtraction problem and one addition problem. Literally, that's it. So it's just a matter of is there a surplus every month for homes? Does it make sense?
And if you guys want to get more information on that, there's the link right there. Get a free consult with Anthony at dealproacademy.com/HELOCs. I'll also leave the links in the description box. I think this is something that every person should take the time in order to really see if it's a good fit for you. It's not for everybody. Some people are not in the situation where this is actually going to work right now, but Anthony will tell you how to get there. You know what I mean? But I do think,
just so we're setting proper expectations,
mm-hmm.
I manage the team here. And so a lot of my time is spent advocating for this, teaching at a larger scale, if that makes sense, making sure that the team here, we're consistent with our messaging. So you'll talk with one of the loan officers on my team. Right now, it's two. It's either Michael Crawford or Jason Cahill. They're awesome. They know this backwards and forwards. So I'm happy to talk with people. I'm not off limits, but when you schedule a call, you'll end up scheduling with one of them, most likely.
And it's not going to cost you anything. So, but a little bit of time. So I do think this is something that you should look into. There's several people on the line right now that have done it already. In fact, I just saw Dr. Keith Harris. He said, I started my insurance policy after hearing this from you about a year ago. So there are people who are doing this. This is an insurance policy with the infinite banking situation, but there's clients that Anthony have been working with who's on the line right now, and they're successfully using the HELOCs. Now, what's the failure rate on this, man?
Sorry,
what's the failure rate? The failure rate. How many people actually failed out of all the clients you have?
Okay. So if I look at the default rate, it's 0. 0 is the number. And we've helped over 2,000 people in the past 6 years. Now, I also want to cover for the fact that that's the official number of defaults. That doesn't mean that we haven't had people that didn't succeed with the product, right? It does mean that they didn't default, they didn't foreclose, right? So there were people that lost track of how this works, right? There were people that we had that lost track of their budget. If we think about what makes this work, the only thing that makes this work is making more money than you spend. Is having a surplus. And so there were people that got into this, right, that either lost track of the discipline piece, that a life event happened, right, and the income decreased drastically for something they couldn't control. And when that happens, we monitor, meaning the bank, like the bank monitors the activity in a way that we look for trends. For instance, if someone's balance is increasing by $1,000 a month for 6 months, we've got someone who will call and say, hey, we noticed this is going on. Usually the direction that we want the balance to go with your first lien HELOC is down, not up. It's been enough time, and we've had enough months where your balance has increased. We want to call and see, is this still, could we have a consultation to look through your budget to see what's going on, right? Because we want to see the balance. Is there something? Are you okay? Is there something going on with you? So we could try and understand what's going on, so we can help support people to either find a way to turn it around so this does benefit them and benefits their life and helps them, meaning they're paying down their balance, or we help them get out before it becomes a problem. Right? We help them get into an amortized mortgage before it becomes a problem. The thing that the amortized mortgage, the 30-year fixed rate, and even a 15 provides, is it provides a guaranteed payment that you have to make every single month. And if you falter on that, even 1 month, you get dinged right away. And the difference with the first lien HELOC is you don't get dinged right away. You don't get dinged at all. Actually. And so you have the ability to spend more and more and more and more every month with no one saying, hey, you spent way too much this month, which is why that whole discipline piece of it is so important.
Absolutely, man.
Because you're in control of your success. And if the household fails with it, they controlled the failure, and no one else, no external factor is gonna ding you until it's too late. But a different scenario, if someone's balance goes up $30,000 this month, that isn't someone who I would assume is living extravagantly and just went on some random Dubai trip. To me, that would be someone who took out $30,000 for an investment, and now it's sitting in the investment, making money. That's less of a red flag, even though it's a much larger number. This particular product, we work with a lot of people who are investors who want access to the capital, $30,000, $50,000, $100,000. If they take that amount and invest it, that's going to bump up their balance by $100,000. That's less concerning to me, even though traditional bankers might flip out about it. That's less concerning to me from a success standpoint, because that's one of the things that we know people can do, and we teach people to do that as well. So that to me isn't like, hey, they went and bought a Lambo and they're going to drive around in this expensive car and crash it. No, it's like they probably bought a flip house cash, and then there's another 20,000, 30,000 went into a rehab, and then they sold it, and then instead of putting the 120 back, they're putting 180 back, and which pays it back down by an additional $40,000. So we see that isn't as concerning. It's more about the general increase.
So I'm glad we were able to tackle this 50-year mortgage from different scenarios, man. Even from a scenario of trying to make it work, trying to see how it can work. I think we came up with one scenario where it might work, and that's the appreciation of the market, but then that hurts the buyers on the other end. So it's not really a balanced idea, in my opinion, for homeowners. And again, it's all speculation at this point. Trump announced this 2 days ago. We don't have all the facts. We don't have all the details just yet. So we wanted to hop on today just to kind of see from different perspectives, using different scenarios, using actual numbers, how this can or cannot be beneficial, and why the first lien HELOC would be obviously superior to it. You got some time for some questions?
Absolutely.
Sounds good, man. So we got, let's see, Dragon Manifest. He says next is lifetime mortgages. Yeah, we brought that out earlier. We have Lakita Galloway, and she says, what's the purpose behind a 50-year mortgage? I think we kind of addressed that, man, but just to reiterate it just a little bit, I think is being used to stimulate more home buying. This is a slow market right now. I'm a house flipper as well. And, Anthony will tell you, I had houses sitting on the market for 2 years, a year and a half at this point. It's a really slow market, paying interest on it, so not every house is sitting on the market, but, I got 2 that's sitting on the market, right? Well, one of them is actually, we found a buyer. We're actually closing in a few weeks, but I got one more house that's going to be sitting on the market. I just did a price drop on it. So this is being used to stimulate the market. as far as the no credit score stuff, again, that's being used to simulate the market, but I think is a trap. I think is just, they're literally setting you up for failure.
You know what I wonder? You know what I wonder? I wonder if I think maybe that's the play.
Mm-hmm.
Maybe the play is we want people who, if we know that the average age of people who are starting to become first-time home buyers is
40.
increasing, is 40 right now, right?
Get them while they're younger.
Right. That means that there are fewer people entering the marketplace. So now it's like, hey, we want the younger people to be able to afford homes. We want you to become a homeowner and then refinance into a 30 once you can get a 30. Maybe that's the play. Does that make sense?
It does, man. But even
I don't like it. I don't like it. But if what it does is brings more Americans who are younger who can qualify for a home, who are just holding out for whatever reason. If the whole goal is to try and influence people to enter the marketplace to become homeowners earlier, because they're confident that they can afford a home, even if the 50-year mortgage is a terrible idea, which I think we kind of came to that conclusion. If the approach to that is, hey, look, I can make this more affordable for you so you can be a first-time homeowner buying a $350,000 house. If that changes the perception and more people enter the marketplace to buy a home, they get a 50-year mortgage because that's the way that they can do it, which again doesn't really help that much. But if they think it can help, then they get into a 50-year mortgage for 3 years. Then they flip it. And now they're actually a homeowner and they're not a renter anymore, which is a good thing.
That is a good thing. But again, how it's going to be really difficult for somebody to be able to refinance. There's no equity being built in a house.
Yeah, you're right.
So
it's kind of like a dead end. Yeah. It's like a Band-Aid.
Unless, again, there's a spike in appreciation. But I can see it just crumbling the housing market, man.
But if there's a spike in appreciation, now you're back in the same boat you were before, where home prices aren't affordable. So now we get to the 70, and then the Century, the lifetime loan that we talked about, that they brought up earlier. That's not a solution. That's not a solution that's going to be viable for the long term.
Right. I don't think so, man. I think it was an idea. I don't think much thought went into that. But again, it's all speculation at this point. She said, will there be a penalty to paying it off early? That's something we don't know yet. Not enough details.
Is she talking about the HELOC or is she talking about the 50-year mortgage?
Let's talk about both, man. Do you think there's going to be a penalty on a 50-year mortgage if you pay it off early? I guess that kind of ties into the refi we just spoken about. I don't even think you're going to have enough appreciation in order to be able to justify.
I don't think you are either. I don't think. I doubt there will be. With most 30-year fixed rate mortgages, there isn't. There's no prepayment penalty. So I doubt there would be. With a First Lien HELOC, it depends on the bank. We don't have a prepayment penalty, or that would kind of counter our whole philosophy of pay off the home fast. And so there's no penalty with ours if you pay it to zero, if you pay it off really, really quickly. Right. But yeah, I don't think it makes sense with a 50, because from a regulatory standpoint, that would de-incentivize people from refinancing out of a 50-year mortgage, and a 50-year mortgage is not in their best interest. So it's like, if they were to put a 1 year or a 2 year prepayment penalty onto a 50-year mortgage, that would really put a lot of people out, because you're forcing them into this. They'd be signing up for it, but once they're signed up, they're stuck for 2 years in this terrible, terrible situation. If that were me and I got into it to become a homeowner, I'd try and get out of it as quickly as I possibly can.
If you can,
still try to get the house.
Because I feel like it's a trap, man, at the end of the day.
Yeah.
Gwendolyn Bonner says, can the trustee HELOC a fully paid property in a trust? Well, I guess, can you put a HELOC in a fully, I'm trying to understand the question.
If the question is, can you, if the property is owned by a trust, can you write a HELOC to it? If it is an inter vivos revocable trust, yes. If it is an irrevocable trust, no. And so it depends on the type of trust that you've got.
Which most lenders will allow you to do that. Even if you get a regular mortgage, you can, the very next day, you can put the property in a
Right.
revocable trust.
Yep.
It's called the Garn-Saint-Germain Act,
Yep.
where you can actually transfer your property. Anybody can transfer their, any type of loan on any type of mortgage into the property without penalty or triggering a due on sale clause.
Yep.
So that's good to know for you guys as well. Let's see. Jesus says the math ain't mathing with this 40-year thing, man. I definitely, he said people work 40 years, but a 50-year mortgage, people work 40 years to retire.
Right.
A 50-year mortgage, they're just trying to get more tax dollars out of people, in my opinion. That could be
well,
the case.
You're not retiring, you're helping the bank retire. You're helping
pretty
the bank
much, man. Hey, it reminds me of that. There's a video that circulated for a while online. There was a guy who went to the bank, well, an employer, and the employer, number one, the employer never aged throughout the lifetime of this relationship, but the guy stood in a box and he aged. He got paid to stand in a box, and then over time he got a bigger box, and then his box got a better view. It capped out, but the guy never aged. That represented the business. You're basically making the business rich. The business ain't going nowhere, but you're dying, giving away your life. For, that's besides the point of this particular video. But like you said, man, you're making you're retiring the bank.
Yep.
You know what I mean? You're not retiring yourself. So it's a crime, man, in my opinion. But hey, I'm using that term broadly. So we got some other questions here, some other comments, I should say. This is an interesting one. Like the McDonald's theory, get the buyers young. I look at McDonald's, like if you think about, and this is a completely different, this is off the topic, but when I was a kid, we had Ronald McDonald, we had Grimace, we had
Hamburger,
all of these different hamburger. But if you look at McDonald's back then, they were catering. I was born in 81. So McDonald's were catering to the kids back then. Those same kids are me right now. So now you have McCafe, and then you have the modern day technology. That's us right now. So McDonald's, they start off young, like Holhas said, Holus. I don't know if I'm saying that right. Holhas started off young, and then you grow with the client, and then you circle right back around to the kids.
Yep.
You know what I mean? It's
well,
actually
you get their kids because now the adults are going.
Yeah. I guarantee you in 20 years, we become, whatever we're going through at that point, McDonald's is going to cater to that, and then they're going to start the cycle all the way back over. It's a genius marketing plan, really, but that's what they're equating this 50-year mortgage to. It. They're starting from, they want to get a younger population, a younger generation buying more homes, but what they don't realize is it's actually going to hurt them in the long run.
Well, I don't think that younger people being homeowners is inherently bad.
No, not at all, man. But with a 50-year mortgage, it is.
Yeah. What else you got?
So best thing is to buy land and homestead it, max 10-year financing. That's something I could definitely agree with. Or, I love the HELOC theory as well, man. So that's definitely something that you guys should look into. Jesus said banks are starting to put in the mortgage that you can't repay the mortgage early. Let's see. They scraped them. Yep, it's true. Quintessential said, remember the subprime before the 2008 crash, around that 2005, 2006 era, everybody's getting those 100% financing mortgages. Some of them were like 105, 110%. Some people were pulling extra money out, ran the market all the way up. I was a part of the whole thing, man. I was in the business at that point, ran the market all the way up. Then everybody started foreclosing in 08, crashed the market, so they go after the bottom of the barrel. And after that, man, it just crashed the market. People start going to jail.
Mm-hmm. Yeah, it was rough. It was really bad.
Yeah.
And I was sitting with my boss last night and another lender, and we were talking about it, and even then, the government backed a lot of those decisions. A lot of the people that get the bad rap for it are the lenders, and there was some shady stuff going on, no question about that.
Of course.
But the only reason why that stuff was allowed is because they changed the rules on the securities that they were buying, and they are supposed to be buying A+ paper, where they weren't buying A+ paper, they were just calling it that. And they offered the products, and they offered the marketplace for them to buy the products. The government was buying the subprime stuff. It wasn't all portfolio lending. It was, they were buying it, and they set the table for this to happen.
People were lying on their mortgage applications and stuff like that. I mean, it was a disaster, man. They were giving money to any and everybody, and that's the problem. And that's kind of where I think this conversation was going with the no credit situation. You're really giving your money to anybody. Those are the people that's going to end up in jail. Dragon Manifest says people do 30-year mortgages, then refinance or get a second mortgage. So people been doing 50-year mortgages already. That's actually an interesting way to look at it, man. I think that the difference is you'll be locked into a 50-year versus having an option to refinance later on if you decide to get some equity in the property. So it just depends, man. Depends on what's going to happen with the rules and the law. We don't know. But what we do know is a first lien HELOC can be beneficial if you're disciplined enough. So go to dealproacademy.com/HELOC. I believe that's all the questions we have for today, man. Is there anything that you wanted to add? How can our listeners get in contact with you if they wanted to?
You don't have to do all these, the parting words that people have. You don't have to do a first lien HELOC. Go learn about it. It can be really amazing. Do not do a 50-year mortgage. Don't do it.
Yeah.
I'll leave you with that. If you want to get in touch with us, take a look at the link that Jamel has below. That'll be a great way for you to do that. FirstLienHELOC.com is a free educational resource for people to learn about it. So if you want to go check that out, there's a calculator that you can run there too, where you can put in the amount that you owe in the house. You can also input your income and expenses to figure out, if you were to look into this, what would the payoff time look like, to give you a good idea as to what it would look like. But if you want to talk with one of the loan officers on my team that specialize in this, they'll be able to answer any questions that you've got. They can run the calculator for you as well. And it would be a great resource for you to learn about it, see if it's a good fit for you.
Yeah, for sure, man. And, just so you guys know, when you run those numbers through the calculator on First Lien on that link at firstlienheloc.com, those numbers will tell you if this will be a good scenario for you right off the bat. So then it'll help you set up an appointment. It's an easy process to go through it. I think that it's worth everybody going there and at least playing with the calculator to see if the numbers fit for you. So definitely, at the very least, do that. But like Anthony said, absolutely do not get a 50-year mortgage. It makes no financial sense. And if you're really looking to build wealth in real estate, there's other ways to do it. If you're looking for real estate coaching, go to dealprocoaching.com. Be sure to check out dealproacademy.com/HELOCs. And I hope you guys enjoyed today's segment. Let us know what else you want to see. Be sure to like this video, subscribe to the channel, click the notification bell, and leave a comment. And we look forward to seeing you guys on the next one. Take care.